Good morning, everybody. Welcome to this webinar on transaction monitoring. Our special guest today is Irina Samoylova Kunces. She is one of the very few governance, risk and compliance specialists in Australia. She has the experience of working for big banks worldwide. She spent most of her working life in America, Middle East, and Australia. She is bringing in a wealth of knowledge to all of us. We'll be really pulling apart the understanding we already have, and try to build a brand new understanding as to what forms part of a transaction monitoring program. Am I legible to everyone?
Yes, Ram, you are.
Thank you.
Yes.
I would expect everyone to be muted until we come to the question and answer session. Now, I was actually introducing Irina, who is also part of ACAMS Australia. She is a qualified CAMS specialist, certified anti-money laundering specialist, and a certified auditor. Irina, welcome. Thank you very much for making this time to the benefit of remitters in Australia. Because you have a number of years working for banks in high positions, can you let us know what could be a banker's expectation from the other side of the equation? How do you expect our members to behave, and what kind of minimum controls would you expect for them to have in their compliance policy and practice?
Yeah.
For you to bank them. Yeah.
Yeah. So first of all, thank you so much for having me. Can everybody hear me well?
Yeah, I can hear you.
Okay.
Yes, Irene.
So this is a very good question, and I think I'll kind of like answer it in a couple of different ways. That would depend on the size and the type of the company that the bank is operating in. So the remittance range from the multiple different. Yeah. So remittances kind of go from very small and very particular, just, the FX transaction or some payments transaction, or B2, depending on the type, if it's a person to person or business to business, to very large with a complex product offering. So as the bank, first of all, we need to understand, if I am to take on the remitter and or any technology company with some kind of financial money transfers attached to it, or product offering given to underlying clients, I would want to understand what their business model is, and what is their current business operations, and what their future business operations, considering the fintech landscape that we are looking in Australia and globally right now. It expands and evolves quite quickly. So my projection is I need to understand my client as of today, as of 3 months from now, as of 6 months from now, and 12 months from now. So as a banker, I would at minimum sit down. What I would do, because I used to do an assessment of the AML program and kind of be a part of an approval system. Do we want to do business with that particular fintech? I will always ask for their AML policies, procedures, and or compliance manuals if some jurisdictions don't require specific remittance to have a separate AML program, and all of their underlying procedures if they have such. Some fintechs would have them in JIRA format, sometimes in very technical format, sometimes in very manual format. The banker then should be reviewing the documentation, and then I will have the interview. And the interview will contain of, does the does the fintech, first of all, or remittance company understand their own operations? Does the analyst or whoever is running compliance program understand what they offer and what the risk is? Then I will do the testing of their systems and ensure that policies and procedural manuals are in fact commensurate with the testing, with the procedure manuals, because what we've seen on multiple occasions, being in the banking side and or consulting side and advisory side, is that smaller companies will purchase off-the-shelf policy and procedures, and it just helps no one because it doesn't reflect companies' risks. Banks will understand that it's too good to be true. They will test it if it's a good bank, especially right now, everybody should be testing that. And if there are deviations, that could hurt potentially an opportunity for the remittance to get a banking services in whatever jurisdictions they are. So that's kind of the bare minimum, what I've seen in good banks. What also happened historically, sometimes banks just do not understand that they're dealing with remittances. Sometimes they will onboard them as the technology companies. It will come out at one point. So if one is getting services right now, down the line, it will come out, the remediation will have to be happening, but that's a different story. It's a very long subject to cover.
And we understand that there are banks which have a questionnaire and a score-based questionnaire, and they just ask you to say yes or no, and then at the end of the questionnaire, they come out with, okay, this is less than 50% of my expectation, so I'm just debanking. Do you think that approach is really helpful for both the remittance community as well as the bankers?
That's a very good question. And what you really referring is Australia does that a lot, and it is stepping away. It's a check the box exercise, yes, no. In the US, in the banking institutions that I've worked, that methodology has been changing since 2015 and earlier. So depending on the jurisdiction and the banking institution you operate in, some of them will be more robust, and it will have multiple factors that would be based on a risk-based approach versus the yes-no check exercise. And I think yes-no check exercise also kind of commensurates with what the OSTRAC report format is looking. So I think that's kind of challenging for the smaller institutions to navigate that regulatory landscape and understand, is it yes, no, or is it a more sophisticated risk-based approach that the company will be using? My suggestion to any analyst and or compliance officer in or whoever, I understand, in some institutions, one person cover multiple functions. So just understand your risk. First of all, understand what are the true services that you offer and how they could be exploited. That's just the number one. Then you need to understand what the channels that you're using and how the money disbursements are happening. If there's any financial partner or other platforms that are being used, again, understand what is your risk exposure, how can you be exploited by your potential customers, and how that platform can be exploited. And then 3, understand what are the jurisdictions you truly operate in. Sometimes if you plug in through the APIs, again, I'm talking very generically because we can vary on who's in attendance. Based on the end-to-end transaction, your transaction may be lagging in Australia or in the Middle East, but the full transaction end-to-end will be going cross-border. So that's, if you're in Australia, you truly need to understand your IFTI requirements and if that needs to be reportable, but then also you need to understand how can that be exploited in the end-to-end transaction. So to make it less complex, just understand your risk, understand basics, and then be able to explain that either to the banking partner or to the regulator, how you overcoming or how are you understanding that risk and ensuring that your controls can be commensurate to that risk.
Yeah, at the end of the day, it comes back to the risk and reward proportions that they want to really indulge in. Having this kind of fill the day and then take it off in the evening, that is not really giving the bankers a lot of reward for the level of risk they have to take. That comes with all the loads anyway. We can't, but even if the remitters agree that they can pay for the risk they are taking, that's the kind of situation they are really frustrated, where the banks are closing their eyes on the risk and reward proportion. But at the end of the day, I basically agree that we need to improve. Most of us need to improve also. We close our eyes and start to think that we are fully compliant, but in the third party and the banker's view, it may not be the case. So we need to indulge in a culture where we have to spend all our time in continuously improving our compliance, especially the transaction monitoring and sanction screening. Okay, now consider that there is nothing in place. We have a compliance program and we do screening, we do reporting. What is the first step you want to take in order to construct a very efficient or a strong transaction monitoring, and start with your definition of transaction monitoring?
Yeah. Well, transaction monitoring can be manual or automatic or the mix of the two, right? And again, not to repeat it, but risk assessment and KYC, I think that's truly understanding your own risk.
Sorry. Can others please go on mute kindly, as Ram indicated kindly?
Yeah, I have muted her. Yeah, thank you. Yeah. Go.
So that will actually apply, or you will be building your transaction monitoring to commensurate with the risk that you carry. So if I only operate with, I'm going to be doing basic, like with 5 clients, and my volumes are up to 200 transactions a month. And I know pretty well all those clients because I'm constantly just doing, their transfers from one location to another location. Well, in that scenario, I know my clients, I know what to expect of them. Transaction monitoring probably, or systemic transaction monitoring probably will not pick up any additional risk that I, as a person who offered to face-to-face or whatever the channel that is, I probably would go with the spreadsheet and or the Access, Microsoft Access or any other tool that you're using currently right now. And you can say with an open heart, yes, I understand each transactions. It's within the client's profile or within what I expect of them to do on a monthly basis, and that would be completely sufficient. If I, let's say, operate in multiple jurisdictions and I onboard all of my clients electronically, and I do not do face-to-face and understanding KYC, then I might want to include a lot more robust tools like the online KYC, again, depending how many clients you onboard and what is your resources on a daily basis. Do you have resources who can comply and truly understand your clients? So again, depending on the model, I would just make a risk assessment and say, I operate in one jurisdiction, not many clients. I understand pretty well their operations. I'm okay with a spreadsheet, and that will be fine. But then if you do operate with the multiple product offerings, with multiple different client segments, and that's a critical thing, you need to really understand who you're serving. Because I've been part of the scenarios, we call it OBI, originator beneficiary reporting within the company, and that's a global exercise that banks should be doing. If I serve a remitter and the remitter is opening their account and we see that the account is used by multiple parties, we cannot per se be comfortable that it is the same party. So it's called double nesting. So that's a very risky, and regulators globally look at it from a very high risk perspective. That's why a lot of global de-risking had happened. So a lot of times, like some exchanges or smaller emitters would not understand who they give in that access to the account or who's using that account, and that creates like a payable through risk. Like risk. I don't know if people on the call understand that. Payable through meaning you have an account and then whoever opened that account just give access to other people to use that account. And that is a very high risk from money laundering, terrorist financing, fraud, and so forth. And then so that really will drive your transaction automation.
What kind of weightage a true risk assessment bears in the transaction monitoring processes, and how do you expect a remitter to look through their risk assessment for this purpose?
Well, again, that will very much depend. It's never off the shelf, right? That's the true magic happens when you're truly looking at your own risk. And that's the basics. That's who my customer, what are my jurisdictions, what are the product I use, what are my channels, and then just see, look, if I operate in a high-risk jurisdiction is like close to designated areas or gray areas, I will put more weighted average on that risk assessment. And or my clients, I offer service to multiple different client categories. It could be individuals, but it could be high net worth persons, and some of them located outside. Then ultimately my client risk will be higher risk potentially, and then I will apply different weightage to that segment. And then again, you don't have to, if I operate with some high-risk clients, that doesn't mean that my client base is high risk. That means that I will need to bracket it up in multiple categories. These are the low-risk clients. I know them because they live like right next door to me, and then I know that they do low-value transactions, but these clients, they do high-frequency transactions, and they do FX and so forth. And so that kind of how you bucket it up. And it could be on a spreadsheet, easy spreadsheet with easy macros underneath. You just need to make sure you or your compliance officer understands it. And then your business, if it's more so a large organization, understands it. And then you can articulate your risk and why you weighted it that way to the regulator. Because there's no methodology, one size fits all. It's always, that's why OSTRAC and all the global regulators talk that it's always have to commensurate with your own risk. And step one is really truly understanding your risk.
Yeah, let me again take you back to the risk assessment. I'm conducting a risk assessment now, and my jurisdiction is Yemen. And I came to know that Yemen regulator has incorporated biometric control to that reporting entities and all the people who they are dealing with. Do I consider that as a low risk at the time of risk assessment, or I consider that the Yemen as a jurisdiction as a risk, and then when it comes to mitigation, I bring that as a factor of easing the control? How do you expect me to see that?
Correct. You've hit it right, nail in the head. So you've considered jurisdiction as its own factor. So you do. So there's in the risk assessment, there's three different scenarios. There is an initial risk, right? Then your control and your residual risk. And then so you apply your risk weighted to all of the risks that are happening. And then you truly say, well, but wait a second, I have all of these controls. And you kind of do the mapping exercise. And I've done those many times with this very few products, it should be quite easy. But you say, okay, these are potential exploitation or risks that I might be experiencing, and these are the manual controls or technological controls like biometric solutions that you've said. But then let's say there's biometric solution might cover one area, but then it doesn't really say that you truly know the client because you don't know who they might have, their customers and so forth, and say, well, my manual KYC, because we call up the client and or we collect it through the system, through CRM, say they provide what the products they do, they provide their updates. So we, in a good standing and understanding that we are understanding their risk, and from manual and technological standpoint, we manage it well. So again, high risk doesn't mean you cannot do business. High risk, you just need to make sure that you properly have a sophisticated or not sophisticated, a sufficient and adequate controls. And again, it could be manual, could be mix of manual and automated, in order to demonstrate to the regulator. And honestly sleep well at night, because if you are a reporting person, you can get in trouble and get penalized. So just protect your company and protect and be able to explain to regulator.
I actually brought that question just to clarify to some of our members. See, people have a habit of assessing the risk with the available comforts. I personally thought it was not the right thing to. You need to really take the risk as a risk minus the comforts available as an automated or a natural way of mitigating. So you need to bring that into your process, and then you can bring the comforts to consider the mitigation pressure. Why? Because you would not know when the Yemen authorities have ceased to have that control there. So if you don't divide the comfort as well as the risk into two different portions, it will be difficult for you to manage that risk because it goes out of your boundary. And that's my view. That's why I brought that question to you. Now, we know that we do our risk assessment and make our managerial decisions to deal with them or not to deal with them. And then in case if we bring them into our jurisdiction, into our product, into our people who we deal with, and then we have something called residual risk, which still comes through the processes, okay? And in order to deal with them, we will have a number of red flag monitors, red flag features which are put to work in our monitoring system. So how do you expect our people to consider the risk, the red flags from the residual risk? Can you please explain a little bit?
Yeah, so residual risk will always be there, right? Otherwise, nobody will be in business. So banks have residual risks, remittances have residual risk. This is risk-reward ratio, right? This is why we're there. I would step back and ask the question a little bit differently. What my transaction monitoring should look like versus how do you apply red flags to the residual risk? I wouldn't try to do the latter because it could be an overlap of controls, meaning I would apply my transaction monitoring. I will do the mapping straight into my initial risk scope, right, to my risk assessment. And that will say, okay, I will say if I have a transaction monitoring, I will lay out my key risk indicators. Let's say, the high risk jurisdiction pickup, like again, I'll come back to choosing the transaction monitoring. But then, so I'll align my coverage of my risk indicators to my initial risks. Then I say, well, I have some gaps. Do I have any manual controls that overlap? And then I will kind of look at it in a map and say, does everything cover from the standpoints? Do I have not duplicated controls? Because that's my resource waste, right? Then I'm not efficient. And sometimes it creates siloed risks and two different processes that kind of overlap and people don't know what the right hand does and what the left hand does. So I need to understand, one, do I cover all my risks? Do I robustly and effectively cover? Do I have not duplication and overlaps? And if I do have overlaps, do I understand those overlaps? And two, where the areas that have skill gaps, what do I need to implement in order to fulfill those gaps? And again, that could be manual, and that could be an introduction of an additional technological tool, right? And then just now stepping back and choosing that traditional tool. There are so many different providers out there. Depending on the jurisdiction, some providers, especially in the smaller scale, they might have a very good idea of what the red flags look like. And we've dealt with a couple of the companies like that. But then, sometimes, as Ram, you've mentioned before, they lump sum your transaction monitoring and sanction screening red flags, and sometimes fraud prevention red flags. And it might work well for the smaller companies, as long as you know that all of those indicators, one, applicable to you, and they don't create a redundancy and a waste of resources, and you are not looking at something that doesn't even apply to you. But then on the other side, that all of the red flags not only applicable, but effectively picking up all of your transaction monitoring. And I think, like, from the smaller firms, what I've seen truly as the biggest mistake, they go in, oh, this is a simply acceptable by everyone, I'll just choose this one company that provides transaction monitoring, and it's very expensive. It's a burdensome on the business. And to be honest, Frank, if you look at the controls and what are they looking at, it might be not even applicable to your business. So you're wasting a lot of red flags, per se, as you call them, or risk indicators, and you're not managing your risk correctly. Again, any transaction monitoring or risk should start with your risk understanding, mapping of your controls, manual controls, automatic controls. Are they even applicable? If they're not applicable, see if you can or turn them off, per se, meaning, well, this transaction monitoring offers me this specific indicator, but it doesn't apply. It's always zero, or it's a lot of false positives, and it just doesn't apply to me. Not because it's a lot of false positives, but it's really risk. It's a lot of false positives because it just doesn't apply. Then my board will issue that this is not applicable, and we put a governance document that we turned it off properly. So that would be my thinking. But then from the risk perspective and indicators, again, if you are looking at multiple different providers, look at not that they are acceptable and many people use them. See what indicators that they offer, or how the data flow. First of all, data feed from your company, does it properly go? Does it properly trigger? Probably get someone like yourself or other consultants like, our companies, who can come in and say, look, this is the data that goes in. Yes, this is picks up. Because I've been working with one organization, they've been deploying this large, very well-respected transaction monitoring. For 10 years, they gave zero output. And if you have a very high level of false positives, which was managed on the spreadsheet, and none of them end up in either SAR or SMR or anything suspicious triggered, and it's a high volume, and you have a team looking particularly at that. And if you have transaction monitoring constantly giving either high yield of false positives and or nothing, meaning, you kind of expect there's should be some kind of alerts happening that you should be reviewing, but they're not happening, that's a flag that the transaction monitoring system may not be good for you, or your data flows is not properly picked up, and or your product, depending, again, it's a very complex and it would vary from one to one. So you need to make sure your product offering, your data sets, and your transaction monitoring kind of marry in sync, if that makes sense.
Okay, you are one of those handful of trade-based money laundering specialists. Some of our members also offer commercial transactions. Yep. In this family-based remittance businesses. What's the kind of, and we understand that trade-based money laundering was the first form of money laundering, and this will be the last form of money laundering as well. And how do you think this presents a very complex matter for the capability, again, the trade-based money laundering, the complexity versus our capacity? How do you draw a relationship on that?
Let me summarize, make sure that I understand your question. So, well, I would question if trace-based money laundering is the first or the last one. Cash will always be the king. And then trace-based money laundering, just for, ensure that everybody kind of understands what that is. It's when you do the shipment, I mean, there could be multiple different ones, right? There's an open account trace-based money laundering when the company doesn't submit guarantee letters or something that banks will protect or step in one form or the other between the two people, the shipping company and receiving company, warehousing and so forth. And there's normally the document that will be connected to either your lending facility or they take on your commodity and then they hold it for you and or they guarantee. And so again, there's a very, very complex system what trace-based money laundering means. But the capacity, I guess, again, one thing you need to understand from is if the remitter is offering trace-based trace-based financing.
No, not financing. That's why I wanted to stop you. You went a level higher than that. Remittance provision for traders, those who are importing and exporting. That could be, I think it was my mistake. I didn't put that right because you have so much of specialty. You went very high on that. Now, to a remitter, someone is presenting an invoice. When we were in Dubai, we saw that 70% of the bill of lading were faked, and most of the trade-based money laundering happens from free ports like that. Now, that's not our problem. Now here, does an invoice given to one of our member, does that really provides a conclusive evidence of trade-based money transfer?
Well, as you just rightly said, so there's a lot of them that are fake, right? There are a lot of them that are not only fake, they're duplicate. There's a phantom shipments. There's a very, very different risk. There's a under payment. There's overpayment. There's all type of different money laundering risk associated with that. That's why it's considered to be one of the highest risks in there. So it's not the first, but one of the highest, due to the complexity and how it can be structured. There's quite a few initiatives globally between the companies. So Ostrak just signed UAE Financial Intelligence MOU, the Memorandum of Understanding for the information sharing. There are a couple of the companies, I know you guys spoke to Identity, we're working with them right now. So they offer a solution that and then they kind of like will try to work with the companies like yourself, which could be very good for you. And it's a low cost structure. We can talk about it later. But when they work with the large institutions who will be providing financing solutions, they produce the private key that attached to the transaction, and it kind of follows through the end-to-end life cycle of transaction. What it truly does, it extracts first information, right? So the bill of lading or any other supporting documentation cannot be duplicated or faked because it's already extracted the private key, and then it's a blockchain solution offering. So it travels with the transaction. So if you're one part of the transaction, you can plug into them. Again, I will need to understand which parties are using that, right? Because if the other party does not use them, it makes no sense for you to use them either. So it's the ecosystem that's truly matters here. To short answer to your question, I'm sorry for the complexity because it's not a ABC answer. your trade-based money laundering is high risk, you have to price it as such. A lot of banks, what they do, especially if they are on the two sides of a story, they are verifying documentation, with the other banks and stuff. Again, depending who you're dealing with, the issuing bank, with the advising bank, and so forth, your risk will vary. And then so you need to make sure if you are in that business, you understanding the risk that that specific contract or that specific transaction carry, because it will vary on the spectrum of trade-based financing. And that by taking on the risk, your reward and your controls are in place, that you comfortably say, yes, it makes sense economically for me to take that on, or no, it doesn't take sense to take it on. One thing, smaller companies, and I've seen that quite a lot, saying, oh, it slides, there's too many of them and it's too complex. Unfortunately, 10 years down the road or 5 years down the road, some bank triggers a big review and it comes down back to you, you will be going belly up. The smaller companies normally don't withstand this type of situation, because they will be asked, how did you manage risk? And if you didn't even understand what that product that you offered, that's going to be a very big concern. And a lot of directors then banned from doing business in the financial services at all.
Thank you very much. You actually touched it rightly. Now, collecting a document in proof of suspicion, how far should you already touched it? I'm just turning it a little right towards the right way for our members to understand that. Okay, I'm given with an invoice copy of one of my remittance customers, and it says, and this is the amount, and this is going to. So how far do they have to go down to check the genuinity and the reality of that situation?
It's a very difficult question. It varies from company to company. Again, depends if you have a good working operation with the banking institution and or who's submitting. First of all, see who's going to be guaranteeing and what type of document that is, right? Either you can verify directly, pick up the phone call. That's what trade operations in the banks do. They pick up the phone and then they verify the validity. The first thing, so from the level 1, level 2, level 3, I'll kind of give you a banking perspective. What we did. The first level is first look at the document. What is being shipped? What is being guaranteed? Does the document make sense? And what does that mean is if just the basic, like if the
basically look for indicators for suspicion, yeah.
Correct. So what it means is if they're saying that the shipment is of the cotton and it's way too heavy for the container or way too light, or the pricing does not look correct, those basic things you need to kind of understand what is that payment is going for. Does the goods shipped make sense on the paper? That's the level 1. And majority of alerts and majority of suspicion, that kind of a very strong indicator that something fishy can happen. Then 2, kind of look if the document looks altered. Could it be faked, or could it be changed from one perspective to another? One of the things we always looked at, sanctions nexus. Are there any parties, if you're doing screening, are there any parties that sanction nexus? And that's where if transaction monitoring can be manual, your sanction screening should be automated, because there's no way you can get it right, through just from the open source. And then the 2, other goods that could be, sanctioned or so forth. So if it looks low risk, then it's up to company to decide, do they want to go for that next step to pick up the phone and really call and then verify, or they're dealing with this entity, quite a lot, and then it looks, legit, and there's never been, again, it's your risk-based profile. How much do you understand of the business? And after the first verification of, the phantom shipment, under shipment, or, the overpricing, underpricing, and so forth, the weight and does it make sense that, I don't know, cotton is shipped from, let's say, Siberia? They don't produce cotton in there, right? So I'm just giving you a blank example. So does this make sense that those type of goods will be shipped from that jurisdiction? And then if it all makes sense, and then you're comfortable, then stop there. If company wants to go for, if it's a large sum of money, if you want to pick up the call, then do that as well. So that's where your risk profile and your controls assessment come in place.
You actually touched something now. If it is a sanctioned country and there are sanctioned freight, can you explain the sanctioned freight, please?
Yeah, so from sanctions, there's direct and indirect sanctions, right? So sometimes, and again, that will be included in the shipment documents. You can have, well, here you don't have as much as some risk in the US. Again, depending on the jurisdiction, sometimes there's anti-boycott clauses that could be included, and if you operate with the US, be very careful and make sure that those are complied. But then freight, what it really means, can the ship actually stop somewhere close to or at the sanctioned ports and offload or unload something. So for example, if you bring in oil, you stop in Iran, you unloaded more oil. Is that the possibility? And then there's even more kind of concerning risk, which is harder for the remitters to pick up. It would be, can the payment from the goods like that, like the sanctioned oil or sanctioned medical equipment or stuff like that, could that the proceeds be going through your company? Because that's one of the risks that bankers and or business people will be in the position to understand. That's where the proceeds of money coming from. And then so if your connecting financial institution was kind of risked, or there was some media and or you have a suspicion that the proceeds of money could be coming from the sanctioned countries and they going through your book or your company, that is directly sanction violation on your end, and that's kind of one of the risks that should be in your risk profile as well.
Okay, now we have seen the risk assessment, we have seen what to expect in the red flags. Now the compliance manager or an analyst is picking up this case. At the end of the investigation or the ECDD, what would you expect to see if you were an auditor walking into a remitter's place? Now you are looking into some investigations which went on in that random selection month. What would you, at a minimum, would like to see in the investigation paperwork in the file?
Just to make sure that I understand the question correctly, there's two things you touched here. One, what do you see as an auditor, walking in, what do you see as the output of the investigation? One, I would say, what is the volume of your operations? How many investigations had happened, or how many alerts had triggered? And then what a percentage of those alerts that happened? What percentage of the investigations that happened? And how many filings did you have? And I will look at the industry averages, and are you underperforming or are you overperforming? If you're overperforming, that means there's some very high risk, potentially stuff that, or the offering that you do. If you're picking that up, that's great, but just make sure that you are managing all of them correctly. If it's underperforming, that's potentially you are not picking up and you are not understanding your risk correctly. So again, at the higher level, the percentage of your transactions to the alerts, to the investigations, to the filings have to be within the industry, within like similar companies to you, what they're doing, and or do you think it's proper? Do you think it's according to what you expect that type of business will trigger? Those two things. And then as I think what you also asked if there's a specific an investigation, a very specific investigation happening, how that life cycle of the investigation had happened. Is that correct? Okay, so well, that will vary very differently on the product. You know, the trade finance will look very different to the B2B or B2C. So regardless what that is, the basic steps would be understand what the transaction, and do you have a view from end to end? Meaning, do you know what your part of the transaction was? It end to end itself, meaning between customer and customer, or was it the part of the transaction through any financial customer that you have? So first of all, kind of get that ready. Then make sure that all the parties that touch the transaction through your leg, if you end to end, and or potential other parties, you do your absolute best to collect all those entities and understand what the connectivity is. And then if you feel that there's no suspicious, you need to write out why there's no suspicion. If you understand that there's parties of transaction, something is missing, and or there's an introducer and it's a simple transaction, why there's an introducer. So if there's any third parties to transaction that's unnecessary, and or the opposite way, it's too simplistic, you need to document all of the parties to that. Then make sure that you also document all the channels, meaning how transaction came, to show the regulator and or assist regulator that you kind of done those steps. And then you understand your channel risk. And if that's picked up, again, also look at the jurisdictions. And from jurisdictions, we've said, does Siberia produce cotton, right? And it doesn't. So why did you start looking over there, and why is it suspicious? So if you are doing the filing, make sure you document what that risk is. It's not like, oh, I don't understand transaction, I'm just going to file. But just say, these are the indicators. I'm in a high risk jurisdiction. This was the channel was used. This partner, this bill of lading potentially altered. I started looking at the parties. There's potentially a phantom shipment happening here, which could be an indicator of the human trafficking or fraud, or the money laundering and so forth, and submit it. So if you've done those steps and if you decided not to file, also explain why. Because you know what, I've spoken to that client, they've explained what had happened, this is justification, and save it and have a proper governance around it. So those are the steps, if that makes sense.
Yeah, for them to understand, again, it has to be reasonably justified that the suspicion has been put to sleep, or why you have decided to go ahead and submit an SMR in this case. So if you have decided to go on the safe way by pushing towards the transaction, let it go, then you need to have proofs, arguments ready to go when someone knocks your door, and this should be based on a reasonable person's judgment, right?
Correct.
That's the test we usually put it in.
Yes, and just one thing is also when you do like testing and or the good auditor, they will have a higher percentage of high risk transactions audited versus low risk transactions. So again, just make sure that you can prepare and be able to answer, primarily high risk, mid risk, and then some of the low risk, and just the points of the test that you just explained.
Okay. Thank you very much, Irina. It was so much of wealth of knowledge. Now, I will open this forum for the next 10 minutes for questions. If we didn't go with many questions, then we will come back to one more question. If anyone wants to ask Irina any particular question, please raise your hands in the chat area. I'll open you to ask this question by unmuting you. Munir, who wants to ask a question? Yeah, Kashif wants to ask a question.
Yes.
Yeah.
Hi, Irina.
Hi, how are you?
Yeah, one thing, the people are distributors selling products on eBay, and actual product shipped from the overseas, from China, India, and Pakistan. But the distributor residing in Australia, he is say, receiving the payment where product gone through PayPal and any other source, and then he using us to remit that fund to the ship country where the product shipped to the actual buyer. The distributor has an individual account with us, and he remit the fund to an individual person in overseas country where the product lie and where the product shipped. So when the customer remitting the fund, after 2-3 transactions, we do the due diligence. Through transaction monitoring, we found out he has a PayPal account, and he provide us the bank statement, PayPal statement, but actually he is not paying any tax in Australia. So what will be the risk for these transactions? Because PayPal, because they are receiving money here and their whole amount he transfer with our companies to overseas. So what will be the risk of what we do actually regarding these transactions? We can, because he provided the bank statement, he provided the PayPal statement which shows he received fund from the customer. Bank statement shows yes, he received fund from the PayPal, and he transfer fund from his own bank account. We do all KYC and everything, but after if he's doing 10 transactions in a month, what will be the risks? Or even he is doing the genuine payments, but he is not paying any tax in Australia. What will be the actual risks for these?
Yeah.
Thank you, Kashif.
Yeah, great question, and I think it's quite widespread situation considering a lot of distributors, through Amazon and through eBay and the Alibabas and so forth. I think it's going to be quite similar situation. So there's two things here. I would ask him why he has account with you guys as an individual versus the entity. I think that's the risk number one. I think I would update from your perspective. The first thing I would update your records and make it a business account. It could be small business account and so forth. If he provides you documentation, that's really good. Make sure that when you update the records, you communicate to them. That initially the account was that you viewing that account was not properly set up, and it's a business account as reflects the activity, so you make it a small business. Those communication with the client, it could be manual through the email, but just keep it on the KYC file if the regulator comes in. Keep monitoring. It looks like you're doing good job looking into and understanding underlying transactions. What's your concern with the ATO? I would because there's requirements, on the banking side to do FATCAs and stuff. If he does banking information, and so the bank should be picking up the FATCA and CSR requirements and filings. But I would, considering that there's no tax going on the payments themselves, I would, to protect yourself, I would ask that in the email through him or communication to him, and ask him to either submit the FATCA, documentation that they have with the bank, or potentially the ATO filings, to you, or do as Ram said, do the reasonable attempt to collect those, because depending on Ram, what is your experience? Because my understanding, remitters are not required to manage the ATO, but that's how it could be part of your judgment, is that you have accounts not on the business side but the personal side, which is the incorrect trigger, and that's where your exposure to the regulatory claim would be.
But in this case, Kashif is running two kind of risk. One is that he is providing someone who claims as an individual and trying to do a commercial transaction. This is more towards the banking service he is hanging on to rather than the regulatory. In this case, I will not give much importance to the tax because the authorities already know that transactions are basically running from one jurisdiction to other jurisdiction of Australia. However, the money is flowing through Australia, but they have to be concerned about. But the main concern here is his banking risk. So he needs to be basically tidy his books up. That's my view.
Yeah, but from your perspective, your main risk: update the account and communicate to client, to the business. And in order to be small business, they will be registered business. If they're not registered business and they're doing commercial transactions, that's the risk. And that's where you have to do filing. But if they are registered business and they and you have your KYC correctly updated, you shouldn't be worried about that. But if you suspect that they avoid taxation, for you, right, you wouldn't know if they pay tax or not, because you might be lodging, because it doesn't have GST per se. They might be not on this particular statements, but they will be part of their filings with the ATO. So again, if it's a business account and it's a properly registered business, that should be properly covering you. And if they do actually avoid taxes and they've lied to the ATO that they're not filing them, then it's on them. It's a separate from you.
Yeah, thank you. I have another question from Anne Duong. I'll ask her to unmute. And Anne, please go ahead with your question.
Hi, thank you for your speech, Irina. So refer to the money laundering part that you talk about. You mentioned a info sharing solution by Austrac. So I'm curious, what's the name of it?
So it's not an info sharing solution. So Austrac signed memorandum of understandings with the multiple jurisdictions. What that means somebody is talking. So that means that they share information between the jurisdictions. So if there is a potential money laundering in one side, but as soon as it goes out, historically used to be challenging to understand the full transaction, because you have between the bank, you have to speak to the other bank under 314B and so forth to get the information. Right now, the financial investigating units kind of sharing this information. So with that said, there are solutions that are working with the regulators. One of them that I've mentioned is the identity. Then we're kind of like speaking with them and helping, kind of get their solution and apply to the small institution. Is it applicable even or not? Again, it's not a bulletproof solution. There's a couple of the other ones, blockchain solutions out there. What you need to understand is, does the banking partner or financial partners that you are using in certain jurisdictions, so end-to-end transaction, are all the financial services partners using the same solution? If they do, then it's helpful to you, because then you can overlay the transaction with the solution, and it carries the information to help you to prevent money laundering, to help you to prevent fraud and all the other risks. But if they don't, that's where it's very limited, right? So if we're talking about Australia only, so this particular solution is working with Austrac on the reporting of IFTI requirements. So again, we can speak, and this is something that we're going to be working with RAM and helping companies like you potentially work with them with those solutions and the other solutions if that's of interest. But then if not, you just need to make sure that, and then so they are working with all the financial like open banking partners, which will be providing the transactional transparency into all the ecosystem. So if you're working with the 2 or 3, let's say, partners through the APIs or the financial service provider, that information will be flowing through between all partners. So there's a couple of the solutions, but this particular one called identity.
Thank you very much, Irina. It's time for us to leave you. Thank you very much for providing your time. Your wine bottle is with me. I'll give you when I meet you in Sydney.
No
Thank you very much. Thank you.
Thank you. Bye.
Thank you, everyone. Thank you.